Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Carry forward. Carry forward pertains to the ability to transfer unused RRSP, Registered Retirement Savings Plan, contribution room from previous years to subsequent ones. For instance, if an individual had an RRSP contribution limit of $13,500 but only contributed $10,000, the remaining $3,500 can be carried forward and utilized in the future. This unused contribution room remains available indefinitely, providing individuals with the flexibility to maximize their retirement savings over time by making contributions in excess of their annual limits. Carrying charges. Carrying charges encompass expenses that are eligible for deduction in terms of taxation. These charges refer to costs incurred in holding and managing investments, assets, or properties. Recognized as deductible expenses, they can be subtracted from taxable income, effectively reducing the taxable portion and potentially leading to lower tax liabilities. By accounting for carrying charges, individuals and businesses can optimize their tax positions and enhance their overall financial strategies. Cash account. A cash account is a specific type of brokerage account where the investor is required to either have sufficient cash available to cover their purchases or ensure that the required amount of cash is delivered prior to the settlement date of the purchase. In this type of account, transactions are conducted using the available cash balance, ensuring that the investor's funds are readily accessible and used for trading activities. Cash accounts are distinct from margin accounts, which allow investors to borrow funds to execute trades, and they provide a straightforward approach for investors to manage their investments using their own available funds. Cash flow. Cash flow encompasses various financial contexts. In terms of a company, it represents the profit recorded over a specific period, inclusive of deductions that do not involve actual cash disbursement, like depreciation. For investors, it includes all forms of income from investments, such as dividends, interest, and rental income. Additionally, cash flow can denote the movement of funds in or out of an account or portfolio. This concept serves as a comprehensive indicator of financial health, both for businesses and investors, by reflecting income, expenses, and liquidity dynamics. Cash flow to total debt outstanding ratio. The cash flow to total debt outstanding ratio is a financial metric that evaluates a company's capacity to fulfill its debt obligations. This ratio measures the proportion of cash flow generated by the company compared to the total outstanding debt. It provides insight into the company's ability to repay its borrowed funds, especially considering short-term borrowings that typically require repayment or renewal within a year. By assessing this ratio, investors and analysts can assess the company's financial strength and its ability to meet its financial commitments, helping inform investment decisions. Cash secured put right. A cash secured put right strategy entails writing a put option while reserving an amount of cash equivalent to the option's strike price. In the event of being assigned, the cash secured put writer employs the reserved cash to purchase the underlying stock from the exercising put buyer. This strategy offers a safeguard by ensuring that the necessary funds are available to fulfill the obligation if the put option is exercised. By employing this approach, investors can potentially generate income through option premiums while managing the risk associated with the possibility of assignment. CUD. CUD is an electronic trading system designed for fixed income securities, functioning within the retail market. This platform facilitates trading activities in the fixed income sector, providing a streamlined and electronic approach for investors to engage in buying and selling these types of securities. It offers a convenient and efficient way for participants in the retail market to trade fixed income instruments, enhancing accessibility and liquidity in this financial market segment. CUD Institutional. QID Institutional is an electronic trading system tailored for fixed income securities, specifically catering to the institutional market. This platform serves as a technological solution for institutions to engage in trading activities involving fixed income instruments. By utilizing QID Institutional, participants in the institutional market can conduct transactions in a streamlined and efficient manner, contributing to increased liquidity and accessibility within the fixed income securities sector targeted at institutional investors. CDS Clearing and Depository Services Incorporated, CDS. QID Institutional is an electronic trading system tailored for fixed income securities, specifically catering to the institutional market. This platform serves as a technological solution for institutions to engage in trading activities involving fixed income instruments. By utilizing QID Institutional, participants in the institutional market can conduct transactions in a streamlined and efficient manner, contributing to increased liquidity and accessibility within the fixed income securities sector targeted at institutional investors. Central Bank. A central bank is an institution created by a national government to oversee currency and monetary policies at both national and international levels. In Canada, this role is fulfilled by the Bank of Canada, in the United States, by the Federal Reserve Board, and in the United Kingdom, by the Bank of England. The central bank plays a crucial role in managing a country's money supply, interest rates, and overall economic stability, with the aim of ensuring sustainable economic growth and financial stability. Chart analysis. Chart analysis involves utilizing charts and patterns to predict optimal buy and sell decisions in trading. This approach, often referred to as technical analysis, relies on analyzing historical price and volume data presented in charts to identify trends, patterns, and potential market movements. Traders and investors use chart analysis to make informed decisions based on the visual representation of price movements and patterns, aiming to anticipate future price changes and optimize their trading strategies. Class A and B stock. Class A and Class B stocks refer to different categories of shares within a company, each with its own set of rights and characteristics. These classes of shares can have varying levels of claims and privileges. Class A shares typically have priority in terms of dividends or assets over Class B shares, and may not have voting rights. On the other hand, Class B shares might possess voting rights but may not enjoy the same level of priority in dividends or assets as Class A shares. It's important to note that these distinctions can vary from company to company and do not always follow a fixed pattern. Clearing. Clearing is the procedural step in the financial markets where the details of a security trade are verified, confirmed, and matched between the buyer and the seller. This process ensures accuracy in the transaction and helps prevent discrepancies or errors. Clearing involves validating key trade information such as the securities type, quantity, price, and settlement date. This verification process is crucial for maintaining the integrity and efficiency of the financial markets by reducing the potential for errors and disputes in trade execution. Clearing corporations. Clearing corporations are nonprofit service organizations that are owned by exchanges and their members. They play a crucial role in the financial markets by facilitating the clearance, settlement, and issuance of options and futures contracts. When trades are executed, clearing corporations step in to verify and match the trade details, ensuring accuracy and reducing the risk of errors. They also act as intermediaries, becoming the counterparty to every options and futures trade, guaranteeing the performance of both buyers and sellers. This guarantees the completion of trades and helps maintain the stability and integrity of the markets. Closed-end discretionary funds. Closed-end discretionary funds, also referred to as interval funds, are investment funds that offer a unique structure. Unlike traditional closed-end funds that issue a fixed number of shares that trade on secondary markets, closed-end discretionary funds have the flexibility to periodically buy back their outstanding shares from investors. This allows investors to have an opportunity to redeem their shares at specific intervals, typically determined by the fund's management. By offering periodic share buybacks, These funds provide investors with a level of liquidity and flexibility that is not commonly associated with traditional closed-end funds. This feature can be particularly attractive for investors who want exposure to the fund's investment strategy but also value the option to exit their investment at predetermined intervals. Closed-end fund. A closed-end fund is an investment company that issues a fixed number of shares that are traded on the open market, similar to regular stocks. Unlike open-end mutual funds, which continuously issue and redeem shares at their net asset value, closed-end funds have a fixed number of shares available. This fixed capitalization means that new investors can buy shares from existing shareholders on the secondary market. Because the number of shares is limited, the market price of a closed-end fund's shares can deviate from its net asset value. This can lead to trading at a premium or discount to the fund's underlying assets. Closed-end funds can offer a diverse range of investment strategies and asset classes, providing investors with the opportunity for capital appreciation and income. Closet indexing. Closet indexing is a portfolio management strategy where a fund manager closely mirrors the composition and weightings of a market index while still aiming to actively manage the fund. This approach aims to create a perception of active management to attract investors, while in reality, the fund's performance closely tracks that of the benchmark index. By doing so, the fund manager avoids deviating significantly from the index and potentially underperforming, while also minimizing the effort and risk associated with true active management. This strategy can sometimes be criticized for charging active management fees while delivering performance similar to passive index funds. Coincident indicators. Coincident indicators are sets of statistical data that exhibit a tendency to change at roughly the same time and in a consistent direction as the overall economy. These indicators provide insight into the current state of the economy and its level of activity. They include metrics such as employment rates, industrial production, and retail sales, which tend to rise during periods of economic growth and decline during economic downturns. Coincident indicators are valuable tools for analyzing and tracking the health of the economy in real time, helping policymakers and investors make informed decisions. Collateral trust bond. A collateral trust bond is a type of bond that is backed by assets such as stocks, bonds, or other securities that are held in trust by a designated trustee. These assets serve as collateral, providing a level of security to bondholders. The issuing company deposits these assets with the trustee, which acts as a safeguard for bondholders in case the issuer defaults on the bond. If a default occurs, the trustee can sell the collateral assets to fulfill the bond's obligations to investors. This arrangement provides an added layer of protection and assurance to those holding collateral trust bonds. Commercial paper. Commercial paper refers to a type of short-term financial instrument issued by corporations or backed by a pool of financial assets. It comes in two forms: unsecured promissory notes issued by companies or asset-backed securities supported by a collection of underlying financial assets. The maturity period for commercial paper typically ranges from less than 3 months to 1 year. These instruments are often traded in multiples of $1,000, with a minimum initial investment requirement of $25,000. Importantly, commercial paper can be traded in the secondary market before its maturity date, allowing investors to buy and sell it at prevailing market rates. Commission. A commission refers to the fee imposed by a stockbroker when executing the purchase or sale of securities on behalf of a client, acting as an agent. This fee compensates the broker for facilitating the trade and managing the transaction process. Commodity. A commodity is a tradable product that holds value for commercial purposes and is listed on organized exchanges. Examples encompass agricultural goods like wheat or canola, as well as natural resources such as oil or gold. Commodities often serve as the underlying assets for futures contracts, providing a way to speculate on price movements. Commodity ETF. Commodity ETFs are investment funds that track the price movements of commodities. There are 3 main types: physical-based ETFs that hold actual commodities like gold and oil, futures-based ETFs that use futures contracts to follow commodity prices, and equity-based ETFs that invest in companies related to commodities. Each type has its pros and cons, appealing to different investors based on their preferences and market outlook. It's crucial for investors to grasp the characteristics and risks of these ETFs before investing. Commodity futures. Commodity futures are financial agreements where two parties commit to buy or sell a certain quantity of a commodity, such as oil, gold, or agricultural products, at a set price on a specified date in the future. These contracts serve as a way for producers and consumers to manage the risk of price fluctuations. Commodity pools. Commodity pools are distinct mutual funds that possess the capability to utilize leverage and engage in short selling using derivatives. These pools offer a means for retail investors to access certain hedge fund strategies, allowing them to participate in specialized investment approaches that involve commodities and related derivatives. This arrangement provides investors with exposure to potentially higher risk, higher reward strategies that differ from traditional mutual funds. Common shares. Common shares, also known as common stock, are securities that signify ownership in a company. Holders of common shares have voting rights and may participate in key decisions through voting privileges. Additionally, they are eligible to receive dividends when declared by the company's management. Common shares represent a fundamental form of equity ownership in a corporation. Competitive tender. Competitive tender is a method employed by institutions like the Bank of Canada to allocate new government marketable bonds. In this process, primary distributors submit bids, and the highest bids are selected to distribute the securities. This contrasts with non-competitive tender, where bids are accepted at the average price. The competitive tender process aims to ensure efficient distribution of bonds to institutions offering the most favorable terms. Compound interest. Compound interest refers to the interest that accrues on an investment over regular intervals and is added to the initial investment amount. Subsequent interest calculations are then based on the augmented total, leading to a compounding effect. This means that interest is earned not only on the initial investment but also on the accumulated interest, resulting in exponential growth of the investment over time. Confirmation. A confirmation is a formal document sent by a broker or investment dealer to a client shortly after executing a securities transaction. It provides comprehensive details of the purchase or sale of a security, including relevant information such as the type of security, quantity, price, and transaction date. Essentially, a confirmation serves as a tangible record of the executed trade, and is an essential part of maintaining accurate transaction records for both parties involved. It's also commonly referred to as a contract in some contexts. Consolidated financial statements. Consolidated financial statements refer to comprehensive financial reports that combine the financial data of a parent company and its subsidiary entities. These statements provide a unified view of the financial position, performance, and cash flows of the entire group. By aggregating the financial information of all affiliated companies, consolidated financial statements offer a clearer understanding of the overall health and operations of the corporate group, assisting investors, analysts, and stakeholders in making informed decisions. Consolidation. Consolidation, also known as a reverse split, happens when a company reduces the number of its outstanding shares and increases the share price proportionally. This process is often used when a company's stock price has become very low, and the company wants to increase the per-share value to make the stock more attractive to investors. For example, in a 1-for-10 reverse split, an investor holding 10 shares at $1 each would end up with 1 share at $10 after the consolidation. This maneuver is intended to improve the perception of the company's stock and enhance its trading liquidity. Consumer finance company. A consumer finance company is an institution that specializes in providing direct cash loans to individuals who may have difficulty obtaining loans from traditional banks. These companies cater to consumers who need access to funds for various purposes but may not meet the stringent criteria of conventional banks. Due to the higher risk associated with lending to these individuals, consumer finance companies often charge higher interest rates compared to traditional banks. This higher interest rate compensates for the increased risk and serves as a way for these companies to generate revenue from their lending activities. Contrarian investors. Contrarian investors are individuals who adopt an investment strategy that goes against the prevailing market sentiment. Instead of following the crowd, contrarians actively seek out opportunities by analyzing sentiment indicators to gauge what the majority of investors anticipate in terms of future price movements. Once they identify a situation where the consensus opinion is overly optimistic or pessimistic, contrarian investors take a different approach by going against the prevailing sentiment. This approach is based on the belief that market sentiment can lead to overreactions and mispricing, creating opportunities for contrarians to profit from price movements that deviate from the mainstream expectations. Consumer Price Index, CPI. The Consumer Price Index, CPI, is a metric used to gauge the cost of living by assessing the prices of a predefined collection of goods and services. This index serves as a crucial indicator of inflation, reflecting changes in the overall price level over time. By monitoring fluctuations in the CPI, economists, policymakers, and investors can better understand the impact of price changes on consumers and make informed decisions related to economic conditions and financial strategies. Continuation pattern. A continuation pattern is a recognizable chart formation that suggests the prevailing trend in the market is likely to persist. Traders and analysts use these patterns to anticipate that the existing price movement, whether upward or downward, will continue after a temporary pause or consolidation period. Recognizing continuation patterns can assist investors in making informed decisions about their trading strategies and positions, based on the expected continuation of the prevailing trend. Continuous public disclosure. Continuous public disclosure refers to the ongoing and regular release of information by publicly traded companies to the investing public. This information is typically required by regulatory bodies to ensure transparency and to provide investors with accurate and timely updates about the company's financial performance, operations, risks, and other material information. Continuous public disclosure includes the filing of periodic reports such as quarterly and annual financial statements, as well as any significant developments or events that could impact the company's stock price. This practice enhances market integrity, facilitates informed investment decisions, and promotes fair and efficient capital markets. Contract holder. The contract holder is the individual who owns a segregated fund contract. This person has entered into an agreement with an insurance company to invest in a segregated fund, which is a type of investment fund with certain insurance features. The contract holder has the right to choose investment options within the fund and may also designate beneficiaries to receive the proceeds of the contract upon their death. The contract holder is responsible for making contributions, monitoring the performance of the fund, and making decisions regarding withdrawals and other contract-related matters. Contraction. A contraction refers to a phase in the economic cycle characterized by a decline in economic activity. During a contraction, various economic indicators such as GDP, gross domestic product, employment, and consumer spending show negative trends. This phase is often associated with decreased production, reduced business investment, rising unemployment, and slower consumer spending. If a contraction persists and deepens, it can lead to a recession, which is a more prolonged and severe downturn in economic activity. Central banks and governments often implement monetary and fiscal policies to counteract contractions and stimulate economic growth. Contribution in kind. Contribution in kind refers to the act of transferring assets, such as securities, directly into a registered retirement savings plan, RRSP, without converting them into cash first. However, this transfer is treated as if the assets were sold at their current market value, leading to potential capital gains taxation. While any capital gains are subject to taxation, any resulting capital losses from this transfer cannot be claimed. This practice allows individuals to contribute non-cash assets to their RRSPs while considering the tax implications of the deemed disposition of those assets. Control position. A control position refers to owning a significant amount of voting stock in a company that enables an individual or entity to have a substantial influence over its operations and decisions. In most Canadian provinces, except for Manitoba, New Brunswick, and Quebec, holding at least 20% of the company's shares is considered to represent a position of control. This level of ownership provides the holder with significant sway in shaping the company's direction and decision-making processes. Conversion price. Conversion price refers to the predetermined value in dollars at which a convertible bond or security can be exchanged for a specific number of common stock shares. This conversion price serves as the basis for determining the number of shares an investor will receive upon converting the convertible instrument into equity. Conversion privilege. Conversion privilege refers to the right granted to the holder of a convertible security, such as a convertible bond or convertible preferred stock, to exchange that security for a predetermined number of common shares at a specified conversion price. This privilege allows the investor to convert their fixed income investment into an equity position, taking advantage of potential stock price appreciation. The terms and conditions of the conversion privilege are outlined in the securities prospectus or convertible. A convertible security, such as a convertible bond, debenture, or preferred share, provides the holder with the option to exchange it for a predetermined number of common stock shares of the same company, based on the terms specified in the conversion privilege. This allows the investor to participate in potential gains in the company's stock price. Additionally, some companies have the right to force the conversion of these securities by redeeming them at a price lower than the prevailing market price, encouraging conversion. Convertible arbitrage strategy. The convertible arbitrage strategy is designed to capitalize on discrepancies in pricing between a convertible security and the corresponding underlying stock. In this strategy, an investor might take a long position in the convertible bond while simultaneously taking a short position in the common stock of the same company. This approach seeks to profit from any potential misalignments between the value of the convertible bond and the value of the underlying stock. By carefully analyzing market conditions and pricing dynamics, investors aim to take advantage of opportunities where the convertible bond is undervalued relative to the stock, potentially generating returns from the convergence of these prices over time. Convexity. Convexity is a concept in finance that measures the curvature of the relationship between a bond's price and its yield changes. Specifically, it quantifies how the duration of a bond changes as interest rates fluctuate. When interest rates decrease, bond prices tend to increase more than they would decrease when rates rise. Convexity helps investors understand the nonlinear relationship between bond prices and yield changes, providing insights into how a bond's value might respond to shifts in interest rates. Core holdings. Core holdings refer to the foundational investments within a portfolio, in the context of exchange-traded funds. These are usually passive ETFs that aim to generate consistent and stable returns over the long term. Core holdings are designed to provide broad exposure to major asset classes. On the other hand, satellite holdings are additional investments that may be more focused on specific sectors or strategies, often carrying higher risk and potential for greater returns. This aims to achieve a well-balanced and diversified investment approach. Corporate note. A corporate note is an unsecured financial instrument issued by a corporation, representing a promise to pay a specific amount of interest and repay the principal at a predetermined maturity date. Unlike secured bonds, corporate notes are not backed by specific collateral, making them reliant on the issuer's creditworthiness and ability to honor the payment obligations. These notes are often used by companies to raise short or medium-term capital from investors in the debt markets. The interest rate, maturity date, and terms of repayment are outlined in the note's terms and conditions, providing investors with a clear understanding of their investment. Corporation or company. A corporation or company is a legal entity established under either provincial or federal laws, granting it a distinct identity from its owners. This legal structure ensures that the corporation's shareholders have limited liability, meaning their personal assets are protected from the company's debts and liabilities. The ownership of a corporation is divided into shares, and shareholders' liability is typically limited to the value of their shares. This separation of legal identity allows corporations to engage in business activities, own assets, and enter into contracts independently. Limited liability and separate legal status are key characteristics of corporations, making them a popular choice for various businesses. Correction. A correction refers to a price reversal in the financial markets, often taking place after a security has experienced a period of being either overbought, where prices have risen too quickly and excessively, or oversold, where prices have dropped significantly and rapidly. Corrections are temporary price declines that aim to readjust the market's balance between supply and demand. They can occur within various asset classes, including stocks, bonds, and commodities. Corrections are a natural part of market cycles and can provide opportunities for investors to enter the market at more favorable prices after an extended bullish or bearish trend. Correlation. Correlation refers to the degree of relationship between the price movements of two or more securities. A correlation value ranges from -1 to +1. A correlation of +1 indicates a perfect positive correlation, where the securities move in the same direction with the same magnitude. A correlation of -1 signifies a perfect negative correlation, where the securities move in opposite directions with the same magnitude. In practice, most correlations fall between these extreme values. Diversification is often used to reduce portfolio risk by combining assets with low positive correlations, as this can help mitigate the impact of poor performance in any single security. Cost method. The cost method is an accounting approach applied when a company owns less than 20% of a subsidiary. Under this method, the investor records its investment at the original cost of acquisition and periodically adjusts the investment for any dividends received. Profits or losses of the subsidiary are not recognized on the investor's income statement, and the investment remains listed at its historical cost on the balance sheet. Cost of sales. Cost of sales, also known as cost of goods sold, is a statement of comprehensive income account that reflects the expenses associated with producing goods or services. It includes the direct costs of acquiring raw materials, labor, and manufacturing overhead that are necessary to create the finished products. This expense category is subtracted from the company's total revenue to calculate its gross profit. In essence, cost of sales measures the direct costs incurred to generate the revenue reported on the income statement. Cost-push inflation. Cost-push inflation is a phenomenon in which inflation arises from the increase in production costs, such as wages, raw materials, or energy. When businesses face higher input costs, they may pass on those costs to consumers by raising the prices of their products or services. This can result in a general increase in the overall price level across the economy. Cost-push inflation is often associated with supply shocks, such as disruptions in the supply of key resources, and can lead to a decrease in purchasing power for consumers and reduced economic growth. Coupon bond. A coupon bond is a type of bond that comes with physical coupons attached, representing periodic interest payments that the issuer is obligated to make to the bondholder. These coupons are usually detachable and can be presented for payment on specific dates. Coupon refers to the interest payment, and the bondholder receives these payments until the bond reaches maturity. Once the bond matures, the issuer repays the principal amount to the bondholder. The use of physical coupons has become less common with the widespread adoption of electronic bond trading and payment systems. Coupon rate. The coupon rate is a fixed rate of interest that is stated on a bond certificate. It represents the annual interest payment that the bond issuer commits to paying to the bondholder. By multiplying the coupon rate by the bond's principal, face value, the bondholder can determine the amount of interest they will receive each year. For instance, a bond with a $1,000 face value and a 10% coupon rate would yield $100 in interest annually. This rate remains constant throughout the bond's lifespan and is used to calculate the bond's regular interest payments. The coupon rate is distinct from the bond's yield, which considers the prevailing market price and the total payments over the bond's life. Covenant. A covenant in a bond indenture is a commitment or promise made by the company issuing the debt to fulfill certain obligations. These obligations are often outlined in the bond agreement and are designed to protect the interests of bondholders. An example of a covenant could be a pledge by the company not to issue additional debt that could potentially jeopardize the repayment of the existing bonds. Covenants help ensure that the company operates within certain limits to maintain its financial stability and fulfill its obligations to bondholders. If covenants are violated, it could trigger events such as default or acceleration of repayment. Cover. Covering a short position involves buying back a security that was previously borrowed and sold in the hope that its price would decrease. This action effectively closes the short position and allows the trader to return the borrowed security to the lender. The term cover refers to the act of reversing the short sale by purchasing the security in the open market. This process is used to lock in profits or limit potential losses that may have occurred if the security's price rises instead of falls. Covered call. A covered call is a strategy in which an investor writes a call option while simultaneously owning the underlying stock. This strategy involves selling the right to buy the stock at a specific price, the strike price, to another investor. If the option is exercised, the writer of the covered call uses the owned stock to fulfill their obligation to deliver the shares at the agreed-upon strike price. This strategy can generate additional income through the premiums received from selling the call options, but it also limits potential upside gains on the underlying stock. Covered call ETF. Covered call ETFs utilize the covered call strategy to enhance yield and manage volatility for investors owning the underlying stocks or portfolio within the ETF. These hold a diversified portfolio of stocks and simultaneously write or sell call options on those stocks. They generate additional income from the premiums received for selling call options. While this strategy can provide investors with higher yield potential and reduced risk, it limits potential upside gains. Coverage trader. A coverage trader, also known as an agency trader, is a professional who handles trading activities on behalf of institutional clients. Unlike proprietary traders who use the dealer member's capital to trade for profit, a coverage trader focuses solely on executing trades for clients' accounts. They work to achieve the best possible execution for their clients' orders, taking into consideration factors such as market conditions, price movements, and timing. The goal of a coverage trader is to ensure that the client's trading needs are met effectively and efficiently while adhering to their investment strategies and preferences. Covered writer. A covered writer is an individual who writes, sells, an option while simultaneously holding a position that counteracts the potential obligations of the option contract. This means the writer has an equivalent position on the opposite side of the market, which helps mitigate the risk associated with the short option position. The equivalent position could involve holding the underlying security, a convertible security, or even cash. This strategy is called covered because the writer has the coverage necessary to fulfill their obligations if the option is exercised. In contrast, a naked writer does not have an equivalent position and is exposed to potentially unlimited risk. Creation unit. A creation unit refers to a predefined block of shares within an exchange-traded fund, ETF, that is typically provided by the ETF issuer to an authorized broker. This creation unit is used to facilitate the creation or redemption of ETF shares. Authorized participants, often large institutional investors, can exchange a creation unit for the underlying securities that make up the ETF's portfolio, or vice versa. This process helps keep the ETF's market price closely aligned with its net asset value, NAV, and ensures efficient trading on the stock exchange. Creditor protection. Creditor protection is a feature offered by segregated funds, which are insurance products. In the event of bankruptcy, the insurance proceeds from segregated funds are typically exempt from the provisions of bankruptcy legislation. This means that the funds are shielded from creditors, providing a level of protection for the policyholder's assets. This feature can make segregated funds an attractive option for individuals seeking to safeguard their investments from potential financial risks. Crowdfunding. Crowdfunding is a method of raising capital for new ventures or projects by reaching out to the general public for contributions. This approach often utilizes online platforms to connect creators or entrepreneurs with potential backers. Through crowdfunding, individuals can collectively provide financial support to innovative ideas, startups, artistic endeavors, or charitable causes. This democratized funding model has gained popularity due to its accessibility and the ability to engage a wide audience in supporting various initiatives. Custodian. A custodian is a financial institution or entity responsible for safeguarding and holding the securities and assets owned by a mutual fund or segregated fund. The custodian's role is to ensure the safekeeping of these assets and to perform various administrative functions related to their management. This can include settling trades, collecting interest and dividends, and providing reports to the fund manager and investors. The custodian can be the insurance company issuing the fund or an external firm that meets regulatory requirements and is capable of securely managing the assets. Cycle analysis. Cycle analysis involves analyzing historical price data and patterns in financial markets to identify recurring cycles of price movements. These cycles can be short-term, intermediate-term, or long-term in nature and may correspond to economic, market, or investor sentiment cycles. The goal of cycle analysis is to predict the timing of market trends, reversals, and turning points based on the historical patterns of these cycles. This approach assumes that certain factors, such as economic indicators, investor behavior, and market sentiment, drive these cyclical price movements. By identifying and analyzing these cycles, traders and analysts aim to make more informed decisions about when to enter or exit positions in the market. Cyclical industry. A cyclical industry is one that experiences significant fluctuations in demand and profitability based on the overall economic conditions. These industries are closely tied to the business cycle, with their performance being influenced by changes in consumer spending, investment, and economic growth. During periods of economic expansion, cyclical industries tend to thrive as consumers and businesses increase their spending. Conversely, during economic downturns or recessions, these industries often face reduced demand and declining profits as consumers and businesses cut back on their expenditures. Examples of cyclical industries include automobile manufacturing, construction, travel and leisure, and consumer durables. Cyclical stock. A cyclical stock is a type of stock that belongs to a company operating in an industry that is highly influenced by changes in economic conditions. These stocks tend to experience significant fluctuations in value based on the overall business cycle. When the economy is in a period of expansion, cyclical stocks typically perform well as consumer and business spending increases. For instance, during economic booms, sectors like consumer discretionary, technology, and manufacturing often thrive. Conversely, during economic downturns or recessions, cyclical stocks may face decreased demand and reduced profitability as consumers and businesses cut back on their spending. Examples of cyclical stocks include companies in industries such as automotive, retail, construction, and travel and leisure. As we wrap up this session, we're thrilled to have embarked on this journey together, exploring the foundational terminologies crucial for acing your financial certification exams, including investment funds and Canadian securities. Whether you're preparing to conquer your exams or aiming to enhance your financial lexicon, our channel is here to empower you every step of the way. If you found our insights valuable, remember to show your support with a thumbs up and extend the knowledge to your fellow learners. We trust that these insights will prove indispensable on your road to success. Stay tuned for more enriching content, and remember, your financial expertise is just a click away.